Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome, everyone. My name is Jack Driscoll. I'm a certified financial planner with an office in Bethel Park, located at 2738 South Park Road, called Driscoll Insurance and Financial Services. It's a family business with my son, Brian, my daughter, Krissa, my wife, Kathy. We're the core unit up there, and we handle insurance and also investments. I'm a certified financial planner, also an insurance broker. So what I tried to do over the number of years that I've been in business, which is since 1978, my father had the business before me. So we're actually in the third generation right now. What I tried to do was expand the business to serving the public in many of the areas concerning financial planning and finances, which I consider to be life planning. So I know most people are looking at the markets today, seeing the volatility in the markets and the fluctuations in your 401ks and fearing whether or what impact this will have on your retirement plans. If you're already in retirement, you're possibly fearing what's going on in the markets. So what I thought I would do, I already have a radio show every week that I put on the radio, and you can always check our sign or email our office and get information to that, and I'll attach a link to this show. But what I try to do here, we have market volatility, which I can't say is unprecedented because, as all of you know, we just ran into this back in 07 and 08. We just ran into this after 9/11. And as far back in time with markets, we've had high volatility. So what I'm trying to do right now is, on my radio show, I call it All Things Financial because I discuss all areas of financial planning that most of you and businesses alike have to concern yourselves with, which is, are we protected if one of us dies prematurely? Are we protected if we're already in retirement and then one of us goes into a nursing home? Is our income stabilized so we have enough money to make sure we don't outlive our income or outlive our assets? Do we have other risks with this market turmoil? Could it strip away the assets that we had so carefully designed to be adequate enough to provide a secure retirement? And you know, it's funny because a lot of people need to sit back and think, when you look at this volatility we're seeing in the markets today, do we belong in the markets? Is this good for us to be in the markets? Are we suitable? So I have two questions for you. The one is, do people, each individual person, does the person belong in the stock market, for example? And my second question is, does this money belong in the stock market? We'll run into many cases where money that's allocated for long-term goals, retirement planning. Let's say you're age 30 and you say, my money's being set aside in my 401k for 30 or 35 years for retirement. So I would say, does that money, is it well suited to be able to handle and sustain the volatility in the markets without impacting the person's finances? And in many cases, we would say, yes, that money is the type of money that might belong in the stock market and might be able to weather the volatility, the high degrees of volatility that we will experience most likely in those markets. And in fact, that money can most likely benefit by that volatility. Conversely, I look at that same situation with money in the markets on a 30-year-old, and the person says, this is my money that I'm investing somewhere because I need to build up for a down payment for a home. And I'll say it's the same age group, same age bracket, but a different purpose on the money. And we might determine as financial planners that money does not belong in the market, even though other money that same individual has for long-term goals might. So I want to have all of you ask that question to yourselves when you see this volatility we're seeing right now. If you're in the markets and you're concerned about this negative volatility with China and inflation and oil dropping and Greece, if you're scared about this volatility, what I want you to do is probe deeper. Scared for what? That it will maybe erode investment assets that you need now and cannot afford to lose? Because then we might run into the case and the answer to the question being, maybe you don't belong in these markets, instead of trying to weather through the market volatility. Now, I put out a report, and we put out weekly emails for market updates. I do a lot of services to clients, and I welcome all of you watching the show if you would like access to these reports. This is an example of one of my reports. I'll put out a newsletter out here, Market Volatility, and I just put it out this week. So we put these things together to help those of you in the community that might not be getting this type of resource or advice. And I'm going to read you some excerpts that might help, I hope, qualm some of your fears or concerns if you're having those on what's going on in the world right now. Should you be in or out of investing or anything else? So I thought I'd share with you some ideas that I've shared with my clients on this show. The first is, yes, we have market volatility. And yes, it's higher than it's been recently. But don't forget the last major drop we had in 2008 and 9 dropped the stock market on the Dow from around 14,000, the index point, down to about 6,600, almost 6,700. That's a huge drop. We all know that. We saw it happen. It led to what we refer to in the financial community as the Great Recession. It led to all the mortgage foreclosures that we read about in the newspaper. It read about the mortgage industry crisis. It actually led to, when you look at what happened in 08 and 09, one of the largest collapses, almost collapses, I would say, in the financial industry and community since the Great Depression back in 1929. We were all greatly concerned, justifiably so, of the economy, and was it failing? Was it doomed to fail, and would we go into another depression? Because of aggressive actions by the Fed and the government, they actually averted, in my opinion, an overall crisis. While it was a deep recession, and we began a stock market recovery period in 2009 from those levels, about 7,000 on the Dow, like I said, below that actually, to as high as our recent peak in just 5.5 years, almost straight up to 18,000, over 18,000 on the Dow. Unprecedented high, folks. So doesn't it stand to reason, then looking at that we might expect some pullbacks of maybe 10 or 20% as being reasonable, not unexpected, but rather what took it so long? Well, that's what we seasoned financial professionals are seeing. We were looking in 2014 saying, what's taking so long for a correction? We started seeing signs in the spring that a correction was likely, but we can never predict anything. All we can do as seasoned professionals in financial planning is evaluate trends and what's going on in the world around us. So the most important thing we started seeing now are the drops that many of us expected were already to come. So does that mean we get scared and run out of the market and wait until the markets drop and then try to come back in? Typically, no. Typically what it means is we determine in advance, way back in 2009, in fact, way before that, does our money belong in the markets? Can it sustain long periods of downturns in the market? Can we afford to wait? How long? Could be 3 years, could be 5 years, sometimes it's been 10 years. How long can we afford to wait for the markets to come back, if indeed they do come back without impacting our finances in the meantime, that we needed that money and have to pull out our money while the markets are down and have not yet had a chance to recover. Now we've sustained a permanent loss, haven't we, by not being able to wait. So the key and test on should money be in the markets, one of the keys and tests are time. A second key or test is personality, temperament. Can you withstand the ups and downs in these markets, or does it drive you crazy? If it drives you crazy, back away. Find other alternatives that won't drive you crazy. It's not worth it, folks. All right, now going on with this newsletter, what I was pointing out to people and what I'll try to help those of you watching today, these markets are being rocked all around the world, not just the United States, due to Greece, due to the euro, due to China's, let's say, sluggish and lagging economy. They were booming, as you remember. We thought they were taking over the world in the mid-2000s, and now what's happened is their economy has slowed to the point where China has to come in and provide liquidity to the markets, which they've done this week, and also reduce interest rates to try to spur the economy. So we have seen a lagging economy in China now. Does that mean forever? Probably not. Does that mean a continued downturn from here before it recovers? No one knows. But it does mean these are some of the factors that are driving the uncertainty in the markets worldwide, not only in China. Part of the reason for that is interconnectivity of the world now due to the internet makes it so much easier to buy and sell securities all around the world from anywhere in the world. So that means when a shoe drops over in China, we feel it in the United States. 30 years ago, that wasn't the case. So the world is changing. And this is what's causing some of this increased fluctuation and volatility in overseas markets affecting us in the United States, and volatility in the United States affecting overseas markets. So it's an interconnected world right now, and it affects our financial markets. Now, we do have fears of a rate hike that have pressed on our market over here in the United States a little bit. Are they going to raise, is the Fed going to raise interest rates? Oh no, are they going to raise interest rates? And if they do, what does that mean to our financial markets? Well, it might create a little drag on the financial markets, is the fear. So that has put a little bit of a strain on our markets, even without the China issue. But it's not only China. We have oil dropping. We have, like I said, Greece. We have problems all around the world. But folks, we've always had that. We've always had problems around the world. There are problems, there are opportunities. When we look back at 2009, when we saw that stock market drop, it dropped over 22% in just a small window time frame, even back in 1987. If you remember the drop, Black Monday, October 9th of 1987, the markets during that downturn dropped over 22%. And you know what? Within a year, it actually began its recovery back. And we saw the same thing in 2009. So what we look at in hindsight as investors, and we have to determine, and I'll share this question with those of you watching the show. Are we investors or are we gamblers? Because you have to look at, is the stock market legalized gambling, or is it a resource through which we can professionally invest? Well, when we look in hindsight, were times right after October 9th, 1987, October 9th, 1987 was the collapse or crash that caught us all off guard. It actually turned into the beginning of the greatest bull market in history. So was that actually the better time to invest when stocks went down? And in hindsight, in 2009, when the stock market, the Dow dropped from over 14,000 to a little over 6,600 on the Dow, which was a drastic, horrible drop, people thought. Were people that invested in 2009 and 10 and throughout, through the recovery, geniuses? The difference is, in hindsight, it looks like those were the best times to invest for some people, where at those points in time, it looked like the worst time to invest. So in hindsight, we have to consider, are we long-term investors? If we are, we might see these downturns as opportunities. You know, the stock market has been said to be one of the only markets that people never want to buy anything on sale. We go to Macy's and there's a 25% sale, we're jumping all over it. We go to anywhere and we see a red tag sale or a blue tag sale, we tell all our neighbors and our friends, go buy this. When the stock market drops, we run away as fast as we can. And we look at that as seasoned financial professionals and we say, wait a minute, why aren't they all running into the market? Are all the companies that are in the stock market now all going out of business? Or is it in fact possibly an opportunity to pick up shares that are artificially deflated for a temporary period in time, artificially deflated in price that'll be back at normal price in a month or a year? And should we consider, are these opportune times to pick those up? If history's taught us anything, it's taught us that many of these downturns have been wonderful opportunities to pick up shares in the stock market or in companies that we won't see those lower prices again, ever. And sometimes we will see them repeat themselves. And sometimes you'll see prices drop that are never coming back due to fundamentals in the company or whatever. Prices are dropping for a fundamental reason having to do with the company, as opposed to an overall tidal wave. It's been said stock markets, rise and lower all boats in the sea, just like the ocean. So when the whole market is dropping or the whole market is rising, is that an indication that the companies, or boats in this case, are all doing better or doing worse, or are they just along for the ride? So think about that while we're looking at this. If markets are impacting companies' stock that you otherwise are comfortable with, the company itself, it may be a sale opportunity, and it may be simply that. So when we look at that, we see the old adage, and back in 2009, you'll remember Warren Buffett, I hope, if you followed the markets at all. And Warren Buffett said, be fearful when others are greedy, and be greedy when others are fearful. So are these times of uncertainty actually opportunities, or are these times of uncertainty time to pull out and fear and hide your money? Those are decisions only you as every individual can make, because each one of you are different and each type of money you have in the markets is different. Now, we run into what are the situations and scenarios. So as financial analysts come to us as financial planners, they bring us information and they say, are there fundamental reasons these markets are down or stock prices are down? And when you look at your 401ks, or when you look at any money in any form of category at all, you want to rely on a professional, certified financial planner, in my opinion, rather than just a financial analyst or a financial representative or a financial advisor. You want someone skilled to help you identify all the goals in your life, all the areas of risk in your life, and then help you evaluate which areas of risk you cannot afford to take on your own, which areas of risk you can afford to take on your own. Time is a huge component of how much risk you can or cannot usually afford to take. If you have a long period of time before you need whatever the money is that you're talking about, many times you can afford levels of risk that as you get closer to the need for that money, if you have a need for that money, and some people don't. Some people have categories of money they'll never need. They have sources of income that are stabilized. There's no one dependent on any other source of income. They'll have assets and resources that they're probably going to pass down to the next generations. We do totally different types of planning for that type of money. Market volatility is not necessarily as critical a risk concern as maybe taxes on legacy planning, estate planning, federal income tax planning, capital gains tax planning, step up in basis planning, and cost basis planning. Those are all tax resources we use to maximize the amount of income and the amount of assets going from one generation to the next. And market volatility becomes a much lesser concern. Tax implications sometimes become a much greater concern. Imagine this. You do everything right in the markets, and then upon estate transfer to the next generation, you lose 30 or 40% of the assets due to taxes. Ouch! Market volatility risk dwarfed in comparison in some cases to the tax implications, so their risk in certain circumstances is greater in areas that are different than someone else who's investing for their own retirement, or who's investing to build up money for a home, let's say, or who's investing for college for their children and have 15 years left to go. Do you see the differences in financial planning? The whole world of financial planning is very comprehensive and very complex. So I wanted to share with everyone on the show. I will be back. I will show you excerpts of the show, which I call All Things Financial. We will get into many different areas of financial planning: income taxes, estate taxes, life insurance planning, long-term care insurance. What happens, for example, if we design the best financial plans possibly that we can come up with, and then someone on the way home from our office gets in a car accident, gets a lawsuit for $5 million, the judgment gets awarded against them, and they lose everything they had, even though we did every other component and category right. We saved them from the risk of market volatility, and if they died too soon, and if they went into a nursing home and made sure that inflation couldn't hurt them, fixed their estate taxes, and here we missed the asset protection side. Or people don't have wills or trusts where they need them and they have to see an attorney. So those are the things we'll be bringing in future shows called All Things Financial. I appreciate your tuning in. We'll be back again, and thanks for listening.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through SagePoint Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with SagePoint Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.